Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what is possible in the world of investing. If you've just joined us for the first time, a huge welcome. We have a massive episode today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. We've got a lot to cover. We've got some big news stories. We're going to talk about the wall of worry that the Australian stock market and the global stock market continues to climb. And Luke Larrative joins us for another Pimp My Portfolio. But before all of that, I just want you to stop.
Okay.
And I want you to take a deep breath.
Okay.
And I want you to imagine some calming music.
Okay.
We are 1 month, we're officially 1 month after the horror global bloodbath began.
You wouldn't know it.
Now, I just think it's worth us all stopping and reflecting and thinking about where we are. So it was really the 31st of July that kicked off. So not quite a month, but call it a month. Couldn't wait to talk about this any longer. 31st of July in the States, and then the 1st of August in Australia when it kicked off.
1 week into my holiday in Bali.
Yeah. Mm-hmm. No, you're not allowed to go on any more holidays now. Over the next week, the market, both in Australia and in America, fell 6%. And we saw the headlines. 1 trillion wiped off the global stock market, panic, recession fears, horror global bloodbath, like all of that language. But a month after, from like before it started falling, where do you think we are?
We're almost at record highs. I know that.
Yeah. But in Australia,
in Australia.
So in Australia, we've almost fully recovered.
Yeah.
Where from that, when it started falling, we're down 0.4%. So call it flat. In America, in less than a month since the world was crashing, we're up 2%.
That's unbelievable.
So I think it's just like, we don't need to dwell on this point. We've hit it a lot, but let's take that deep breath and keep that perspective.
It reminds me of an investing strategy I used to employ.
Dollar cost averaging.
No. Well, I used to employ, based off an interview we'd done with an expert. Now, apologies, I can't remember it because this was early days. Before I was really attuned to the dollar cost averaging approach. I was still putting money in more haphazardly.
Okay.
His approach to making the most of drawdowns was to try and put the equivalent amount of money in as the drawdown if you had cash on the side. So let's say you have, $5,000 sitting on the side and the market drops 5%. He's saying take 5% of your cash on the side and put it in.
Yeah.
If it drops 10, take 10. You can work it out from there.
Now, not to impugn the originality of this unnamed expert, but Morgan Housel has written an article on that, and we can include it in the show notes.
Has he?
Yeah.
Nice. Okay, well, that would be handy because I did find it quite a methodical way of approaching these instances, and I've found that since dollar cost averaging, and nothing, and I'm not regretful of this, but since dollar cost averaging, I haven't taken the opportunity when the market falls 6% to try and just top up a little. A, because I was on holidays in Bali and my automated investing is doing the work for me. And there are going to be situations where if that protraction goes for longer than it did, I will benefit. But because it was such a short moment in time, really, only a couple of days, if you don't have a strategy, I guess, then you may have missed out in inverted commas.
Yeah. All right. Well, look, that's our moment of reflection. Let's now hit the sting and get into the news of the day.
News and markets.
All right, Ren, well, let's start with America's September interest rate cut. It is all but guaranteed after the Federal Reserve Chair Jerome Powell said the time has come for policy to adjust.
This has been like the biggest tease. It's like been a slow build up. It's like the Jerome Powell and the Fed have like nodded towards it, and then they've like suggested.
They winked at it.
Yeah, and now Jerome Powell in a speech has said, quote, the time has come for policy to adjust. It is all but guaranteed. guaranteed,
Yeah.
you'd bet. Well, I mean, like plenty of people are betting on it.
Yeah.
It would be kind of funny if they didn't do it.
I know. It's like classic markets.
But I think if you look at like what the recipe is for when it's time to cut rates, in America we have the economic growth slowing, like GDP growth slowing. Inflation is back towards the 2% target, so inflation is really tamed. And then unemployment has ticked up marginally, but ticked up. So it's like the recipe. The ingredients are there.
All right, well, we'll be waiting. The next Federal Reserve meeting is September 17th and 18th. All eyes will be on them. Ren, Boeing.
Oh, Boeing.
Man, the bad news continues for Boeing. They're going to have to get bailed out from their NASA, from the space station.
Well, let's just start with Boeing. Most people are probably familiar with one of the two big aircraft makers in the world alongside France's Airbus. Boeing is down 31% this year just because they've had disaster after disaster. The CEO got booted. New CEO started on the 8th of August. He came in, he's like an engineer's engineer. That was his reputation. But look, the problems haven't stopped. Like their legacy problems. Last week, issues with two separate aircrafts. They had to temporarily stop test flights of their 777X aircraft. And in the same week, safety regulators in the US ordered inspections of their 787 Dreamliners. So two different plane models. But that was last week's news because this week's news, now it's their Starliner, which is their spacecraft.
Yes.
Now, for context, the last manned mission to the International Space Station, the most recent one, was two US astronauts who had an 8-day trip up to the International Space Station.
Yeah, in June or something.
Yeah. They've now been there 3 months because there's been like a problem. There's like, I think it's a hydrogen leak with Boeing's spacecraft. Was it the Starliner? They've been trying to fix it. NASA have said enough. Now it's coming back to Earth to run further tests on the ground. And NASA have turned to SpaceX and said, can you go and get those astronauts hopefully by February 2025?
Yeah.
So an 8-day trip to the International Space Station is now a 6-month trip.
Crazy. Yeah. So thank you to SpaceX, I think, for being able to do that. But it's pretty nuts to think that, I think the mentality of these guys going up there for 8 days and having to now be there for 8 months. Tough.
So tough. Yeah.
But not good news for Boeing.
Yeah, and look, I think, Boeing, I think we said this when they first started falling, they're so dominant and so protected because they're so strategically important to the US. But God, there would be some pressure to get things right.
Absolutely. It's not a Mr. Beat Up stock just yet, but I'm sure it might make the segment. Let's keep moving. Another headline that caught our attention, Australia's right to disconnect took effect this week, applying to all businesses with 15 or more employees.
So unfortunately for our employees, you're going to keep pestering them at all hours of the day.
Now, the right to disconnect doesn't mean that employers cannot contact their staff after hours.
As you keep telling us.
As I keep telling you. It just means that staff can ignore the attempts at contact.
Yes.
So this was to try and provide a little bit more life balance for some of these employees and industries where it was almost common practice to be speaking and expecting communication with staff at all hours.
Yeah, I think it's just a function of everyone having a phone now, which, a generation ago wasn't a thing.
Yeah.
The era of landlines, this wasn't a problem.
Phone, emails. I remember when my wife was working during COVID at home and her boss sent around an email saying, you know what, guys, it's all right. I give permission for everyone to turn off their laptops at 7:00 on Fridays. Okay. And she was like, but that's
like big law firm life.
I know. And she's like, what is this email? Just let us turn it off at 5 on a Friday. Come on.
Well, no, you got to go. You've chosen the wrong workplace if you want that.
I know. Well, anyway. And finally, Ren, the federal opposition are going hard at big box retailers. First, we had the inquiry into the Aussie supermarkets, Coles and Woolies. Now we've got the National Party pushing to expand the scope now into Bunnings.
Yeah.
They're in the firing line. And opposition leader Peter Dutton has accused big box retailers of price gouging although he is yet to actually produce any specific evidence.
I think that is an important point to make. Yeah, Bunnings seems to be the one that's getting in the firing line, but in the articles there's been like nods to IKEA, and it's basically like any large retailer they're looking at. It is an interesting dynamic that we're watching play out that I think will ripple throughout politics for a long time to come. So it's worth paying attention to. Fun fact about Bunnings as we wrap up, you know how they have that if you find a cheaper price on a stocked item, we'll beat it by 10%?
Yeah.
Like it's so common that I could just rip that off the top of my head. Their neat little trick that they do, which is completely within their right to do, is the vast majority of the things that they range are like only ranged at Bunnings or home brand. Yeah. So you won't be able to find it listed anywhere else.
Yeah.
Smart marketing.
Yeah, it is. Good on them. Now, if you're looking to keep up with the headlines, make sure you signed up to our daily newsletter. You can find a link in the show notes to do so. We'll send you what is important in the world of business and news every day, as well as some questions answered by experts from the community. So, Ren, at the top, you spoke about the rebound that we've just experienced and how we're almost at all-time highs. So we thought it was a good reminder to revisit how the stock market is, the greatest wealth-creating machine in history, despite the wall of worry that it has faced time and time again over the last 100 plus years.
Yeah, now there's two parts to this segment that we want to do. The first is, I guess, short term, and then we want to zoom out a little bit. But let's start short term because over the past 5 years, there's been plenty of reasons to panic. COVID, obviously, Russia invading Ukraine, inflation hitting 7.9% in Australia or 7.8%, the war in the Middle East, the slowing economy, the cost of living crisis. Have I missed anything?
Not making the finals year on year.
China's continued economic slowdown.
China bombing out.
The collapse of the iron ore price and the lithium price and the nickel price, like a lot of Australian minerals. There is a lot of reasons to panic.
Yes.
But in that time, in the past 5 years, the ASX 200 accumulation index, which is an index that measures the ASX 200 with dividends reinvested, up 48%.
Nice.
Despite the COVID crash, despite the fall in 2022, 2023, just the vanilla ASX 200 with dividends reinvested, $100 invested is now $150.
This is just a bulldozer that continues to smash through any wall of worry.
Yeah.
It's like that meme with the train. You know, the meme
I know
with the train.
But keep going,
we'll leave it there.
It's like the bus parked on the tracks is worry.
The bus parked on the tracks is worry.
And then the ASX 200 is okay.
Yeah. We'll get that up on our socials.
Please go to our Instagram and like it because we're going to need...
the first and last time I'll ever speak about a meme on this show.
No, you got to keep doing it. But look, we wanted to zoom out a little bit more because that narrative applies the longer you zoom out as well. So let's zoom out a long way.
Yes.
122 years, because Market Index have the Australian All Ordinaries Index going back to 1900.
Nice.
So 1900 to 2023, what do you think the stock market has done annually on average?
I know the answer to this because we've been rinsing it for years. 13.2%.
13.2%.
On average. It's unbelievable. 13.2%.
And that is climbing a wall of worry. 2 global pandemics, 2 world wars, plenty of smaller wars, a prime minister going missing, a prime minister being dismissed, companies collapsing.
You name it.
Yeah. So let's zoom in on some of the insights that we can learn from this data, and we'll include the source in the show notes as well, so you can look at it yourself. But what can we learn?
I think the first learning is the negative headlines always outweigh the positive in everyone's minds, but the stats are different. 23 negative years out of those 122, so 19%. 99 positive years, 81%. A great reminder of the reason to stay invested. If you try and play the market, you will miss some of those years. The worst year was 2008, down 40%, global financial crisis, no surprises there. The second worst year was 1930, down 28%. Great Depression.
Yeah.
The best year was 1983, up 67%, but that came after two down years, 1981 and 1982. Similar, the second best year was 1975, up 66%. That came after 73 and 74, which were both down years.
So if we just reflect on that for a second, 81 and 82 both down, and then 83 best year ever. 73 and 74 both down. 75 second best year ever. This is like the peril of trying to time the market because so many people try and get out on the way down and say, I'll wait until it's better to get back in.
Yeah.
But whether it's a short, sharp correction like we saw, this month, or, the COVID rebound was super quick. But even here, it's like you have 2 years of down. So you're waiting, you're piling up your cash, sitting on the sideline, and then bang. It rips. And you never know that it's ripping until you're in it.
Yeah.
And so many people miss the recovery.
Yeah.
And that's a real problem.
Yeah.
And
not only the recovery, the best 2 years in 122.
Yeah. And to put that in context, so inflation peaked in Australia at 17.5%, I think 17.7% in 1975. So it's not like people were thinking economic conditions are good, the market's going to rip. It's inflation is incredibly high. Think about how what we were like when it was 7.8%. We didn't know that was the peak. We didn't know we were out of the woods. We felt like we were in the shit. So only in hindsight you look back and you were like, that would have been a good time to
Yeah.
And that is the story over and over again. And that is why we say it's such a difficult thing and such a perilous thing to try and time the market.
Yeah, stay invested. So those are the highlights, but there are some surprising positive years among those 99. So World War I, 1914, 1917 and 1918 were actually positive years.
You wouldn't think that.
You wouldn't think that. World War II, 1939, 40, 42, 43, 44 and 45 were positive years. Wouldn't think that. Harold Holt goes missing.
Yeah, 1967.
Up 43%.
Yeah.
Whitlam dismissed in 1975, market up 63%. They love that. Quintex collapse. Now, this was one of Christopher Skase's companies.
I think
the company.
Yeah.
That was in 1989. The market was up 17%. And in 2001, HIH, which was the largest corporate collapse in Australian history, and also OneTel, the market was up 10%.
Yeah.
So despite all of that.
9/11, I guess, at the end of the year.
The world wars really surprised me. Economic activity perhaps, I'm not sure.
People say war is good for business and all of that stuff. And, especially in a situation like that, you very quickly get to total employment and total, the whole economy becomes
active.
Yeah. But I think the point we're trying to make here is that the history of the stock market is a history of climbing a wall of worry. And companies collapse, prime ministers get dismissed or go missing, wars happen, inflation spikes. There's always a reason not to invest. There's always a reason to wait. I think I used this example on the podcast recently, but I'm going to recycle it. Warren Buffett's dad only invested in gold because he was so worried about the US economy and the US dollar. What did he miss out on? And then compare that to what his son has done by just backing, in his case, his home country, America's entrepreneurial spirit and enterprise.
Yeah.
It's just...
Stay invested.
Stay invested.
Yeah.
I think we made that
point. Forget the noise and let's move on. Now, before we head to a break, we want to let you know that all of our podcasts plus a lot more are now available on YouTube. So if you head to the Equity Mates YouTube channel, you'll find everything we do there plus a lot more. So make sure you subscribe to our YouTube channel.
Here's a little tease. I am writing a script for a YouTube-only video on how Rio Tinto has found itself in the middle of two great power struggles, the US and Russia, and Europe and China.
Well, there you go.
That's YouTube a little tease. Head over to YouTube.
YouTube exclusive. All right, now we're going to take a very quick break, and on the other side, we'll be back with a Pimp My Portfolio with Luke and a community member. It is time for...
Pimp My Portfolio. Pimp My Portfolio.
All right, well, welcome to Pimp My Portfolio, that time where we bring in an expert and a community member to get their portfolio pimped. We have our expert, Luke Larrative from Seneca. Luke, how are you?
Bryce, how are you, mate? Ren?
Hi, mate.
Good, Ren's here as well.
I'm just imagining Luke as Exhibit from Pimp My Ride. It's just...
Oh, my goodness.
He's got a lot more hair than I do.
Yeah, true.
And we have our community member today submitting their portfolio. It is Holly. Holly, welcome to Equity Mates.
Hello, thanks for having me, guys. Super looking forward to it.
Now, Ren, as always, what have we got in Holly's portfolio?
Yeah, so Holly's portfolio is anchored by some big ETF positions. The Beta Shares Diversified All Growth ETF, iShares S&P 500 and iShares Global 100. Together, they make 75% of the portfolio. So a big core position. And then around that, there's a few... individual stocks, BHP about 10%, Woolworths about 5%, and then Northern Star Resources, Pilbara Minerals, Woodside, so a few resources companies, and then finally Appen. So that's the portfolio. Luke, what's the nickname?
The nickname for Holly's portfolio is What Happened, Holly?
Ouch.
Did you say what happened?
What
happened?
What happened?
Yeah, I love a pun.
Sorry, that's bad. That's really bad.
So context here. Well, Holly, how about you talk us through the portfolio and maybe shed some light on why you think Luke's given that name.
I mean, I love a good pun. It can't be as bad as Luke's infamous all punt, no process nickname.
Is that getting a run, is it?
That one.
Your reputation precedes you now, Luke.
Okay, good. I like it. Putting the fear of God into the Equity Mates community.
Literally.
Yeah, the Appen, to be honest, that is a terrible way to start, but that was actually my very first investment.
Oh, lovely. That's what we like to see.
Yes, that was a good start. So classic first mistake. I just heard about it on the grapevine, did none of my own research, lost pretty much all my money in that.
Can you just tell me, just because I think it'd be interesting for people, what would be like your one or two like key takeaways from like the experience of buying a share and like logging on every other day or whatever and seeing it like go down and worrying, and like what is some of the like maybe emotional or behavioural things that you've kind of like learned about yourself during that process?
Yeah, so that pretty much was the start of my investing journey, was putting $1,000 in Appen and just watching it go down. So I was like, this is fun.
We're not laughing at you, we're laughing because we've all done it.
No, yes, I know, it's such a classic. So I actually bought Appen purely because my boyfriend had it. So full disclosure to his portfolio, he always tells me to do my own research, and he never gives me any stock tips. I picked this one all on my own.
Surprised he's still your boyfriend.
So yes, shout out to him for this one. But watching it go down every day, I guess it just shows I didn't really do my own research in the company. So I always just kind of held on to that hope that it would come back. But then again, I don't know enough about the company to know whether or not it will come back. It's honestly still in my portfolio because I'm a bit slack. I haven't sold any shares ever. I've just always just held. And I guess it's just a daily reminder of not to invest in things you don't know about.
Keep it in there, daily reminder.
Asterisk, general advice, but like it is almost the 30 June. And if you were looking to take sell a share, now is not a bad time to do that if it's not a...
There's honestly, I don't think you guys... Yes. No, I don't think you guys get actual dollar values in there, but there is such a minimal amount that I just don't care anymore. So, I pretty much already have lost all my money.
But might as well lose it at the tax department, I suppose, is probably what I'm trying to say as well, if that makes sense.
Because if you sell it and you claim that loss, it can offset a capital gain.
Correct.
Yeah. So that's there's still value in the loss.
And the losses carry forward.
Yeah.
So it's you don't have to use it this year. You can use it next year or year after or whatever.
So, Holly, I want to make you feel a bit better because I had exactly the same first experience with you. I put my first $1,000 into a company. It was Slater and Gordon, and I actually lost or so much money that I couldn't even cover the brokerage to sell it. So I somehow did worse than you. But to make matters worse, as it was falling, I had internalized that idea of buy low, sell high. So as it was falling, I put more into it. So trust me, however bad you're feeling, you still could have done worse.
I could rattle off 10 like
Okay,
that.
yeah.
But I think for me, the big takeaway for both of you is that it wasn't a moment where you said investing is not for me. I'm out for good.
Yes, like that.
Ren
Like that.
subsequently went to make some great investments, and Holly, it looks like you're certainly well on your way to creating a pretty decent core portfolio. So Luke, what are your initial thoughts here?
Again, I'll just do the stocks quickly because it's kind of boring. Who cares what my opinion of stocks are?
That's literally why we do this segment.
It's just, like everyone's got a different view. I could talk you through the thesis, but it's kind of too long. So look, we don't mind Woolworths for a trade at the moment. We bought that not too long ago. After the pretty average results, I think it looks cheap and obviously reasonable business, sort of semi-monopoly type vibes. So don't mind that at these prices. We are very long Pilbara Minerals, so I think it's my second biggest weight in the Seneca Australian shares large cap SMA at the moment. So we like that. We like lithium. If you want to read my lithium thesis, just Google Luke Larrative and lithium. You'll find 1,000 articles. Northern Star seems a bit expensive to me for gold exposure at the moment. That being said, they're all kind of expensive on the ASX, so don't ask me for an alternative. Woodside's a bit of a mess. It's kind of got flat sales growth forecasts out into the future, kind of trying to do some Fugazi renewable energy thing that's not really kind of working. So their best assets are now fully exploited. So I would argue, what are they going to do next? Anyway, that's the stocks app, and you know the drill. You don't need me to tell you about that.
Hang on. Firstly, Holly, what I reckon you do is internalize those sort of one-liners on each of those, and then when you're at dinner with your boyfriend tonight, don't tell you're on with Luke, and just spit out some facts about these portfolios, about these companies.
Oh God, I'm sure he'll be impressed.
So what do you think about the exposure to ETFs?
Oh, BHP is the other one, sorry.
BHP, yeah.
At BHP we own, we're underweight. So I kind of think that's a little bit expensive, but I think the Anglo deal is a good deal. The market won't like it, but on a 3-year view, that'll work out the best for them. And the Anglo's got some kick-ass assets. So, okay, so that's that. On the ETFs, I think that there's overlap. We always kind of bang on about overlap in ETFs, and probably given your other ETF holdings, beta shares, diversified or growth would probably cover, I think, all those. That's like just an equity only, isn't it?
Yeah.
Global. Yeah. So that would cover your S&P 500 and your global 100 stocks. So all you're doing there by adding those two extra is like overweighting large cap relative to sort of mid cap and small cap. I would probably not do that, but that's just me.
And so, Holly, just or for people listening at home who are just wondering, the beta shares diversified all growth is basically the global stock market. The S&P 500 is the US stock market. Global 100 is 100 big multinational companies. But the fact of the matter is, these days, the top of those indexes are all the same big tech companies.
In similar weights.
Yeah.
So you could probably just reduce your admin and hassle and just own like the diversified all growth or any other of the all world stock market index type ETFs that are out there. They're all much the same. So that would be my thoughts. And if you just wanted to run a portfolio that just invested in that beta shares, diversified all growth or equivalent, that would be totally fine. There is no reason you need to do anything else. Now, if you want to run off and have a little dabble in a bit of Woolworths or whatever on the side, all power to you if that's what gets you excited in the morning. But you don't have to do that. You're totally fine just doing the ETF dance.
And then the age-old conundrum of selling down those ETFs, taking into consideration tax,
surprised
or
the
just
Equity Mates community knows what sell means. There's no one seems to know how to sell in this community.
Holly said she's never sold anything.
That's what I'm saying. I don't even know. No one knows.
Yeah, respect, Holly. Just keep collecting. I'm on that vibe as well.
No, I'm off this wholly hard. I'm off this that hard. Need a bit of valuation discipline beat into the equity mates community. But look, I do, on the direct stuff, there is the right time to sell some of those stocks, probably beyond the scope of today's conversation, but certainly you can just use the blue button, the buy button on the stuff like beta shares, diversified high growth or growth, sorry. But the shares, if you're going to buy shares, you're buying them to sell them. That's why so even if it is 5 years down the road when the earnings have quadrupled, there is a price and they will trade at an overpriced level at some point.
I think the big takeaway is, you're certainly on the right track. What Bryce said earlier about picking yourself up from the Appen experience and keep going, that's something to be commended. And I think a lot of people start with they've heard core and satellite and they start it, but they end up having a long list of shares and, not that much in ETFs. So I think the fact that you've got sort of 75% of your money in core ETFs and you're dabbling on the side, the building blocks are emerging and they look pretty good. So,
as long as you know that dabbling on the side is probably reducing your returns.
Yeah.
In the long run, that's the reality.
I started backwards. So we spent so much time chatting about Appen, which is my biggest fail. But it was only after buying the shares that I read the boys' books. I did more research and then I discovered the whole core concept. So during COVID, I just dawdled pretty much the whole time with the money in my bank account. I knew I had to do a core, but it was just totally analysis paralysis on all the ETFs. And it's only really in the last 12-ish months that I committed to building what looks like an overlapping core. So I will adjust.
It's not. Don't stress about it, right? But I think if you never did anything about it, it's not really a big issue. Yeah. I think a lot of people we speak to seem to do this. They buy the shares first.
That was our story.
And then
we started stocks.
Yeah, I obviously have never graduated to the ETFs. So
we'll get you one day. We'll get you one day.
I think that's totally reasonable. I would just think about getting as much money invested in your optimal portfolio as soon as you can, and as soon as reasonable, and both from a mental freedom perspective and really having confidence and conviction in what you're doing, and also from a maximising your compounding on a risk-adjusted basis.
Yeah. I'm pretty sure we even speak in the book, if it's not DHHF, the diversified or growth, it's the Vanguard one, which is VDHG, but they're designed to be the one-stop shop. There is nothing wrong with having, as you said, Luke, that is a portfolio.
And there's, there's iShares, there's Van Eck versions, there's Global X versions. You can pick your poison, right? Do your research and suss out what you think the best deal is, but they all work. There's no difference between them. And I think for the beginner investors, people just getting started out, they get this analysis paralysis that Holly's talking about, comparing ETFs and looking at the historical returns. The historical returns don't mean anything, right? It's complete forgot. Don't worry about them. That what matters is the process that goes into them and how they're put together.
So, Holly, a lot of information we've thrown at you. We appreciate you talking us through the portfolio today. Any final questions for Luke before we wrap it up?
No, I'm pretty much happy with everything you said. I totally agree. The dollar cost averaging into DHHF for the rest of my life, it just seems so... why doesn't everyone else do it? I don't know. I think I started off really complicated.
We ask ourselves the same question.
Bryce, why don't you do it?
I pretty much do it. I do.
I think Holly, to answer your question, they're pretty new products in the scheme of things. Even when Bryce and I started investing, ETFs were a tiny part of the market, and a lot of the products we talk about today didn't exist. So, we've kind of all grown up with these products coming to market and getting more exposure. So
also just a national obsession with housing and there's so many reasons that
people love punting on stocks.
Yeah.
But you make a lot of money punting on stocks sometimes. Yeah. It's a pretty easy thing to sell to people.
Yeah. But in terms of, why didn't we learn about it when we were kids, and, that's why wasn't that how previous generations invested, it wasn't really available to them. So we're pretty lucky that we're investing in this moment when technology's brought costs down and we can take advantage of it.
Yeah. And what you've identified is right. It's just so straightforward and simple.
It seems too easy.
It seems too easy, but that's the beauty of it.
Yeah.
Unfortunately, the world I operate in lives on creating unnecessary complexity to extract a living for themselves. So, there is really simple answers out there. It doesn't necessarily mean that they're the very best answer. Can you do better than that? Yeah, I think you can do better than that. And that's what I do for a living every day. But that being said, is that totally fine? Yes, it is totally passable. It's totally, but is it better than buying a portfolio of 30 ASX listed companies by a country mile? So, is it better than buying a lick? Yeah, way, 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 way better than buying a listed investment company. So that's kind of my view, and I think the guys are doing a great job of promoting that message as well.
The question is it enough? And the answer to that is yes. So we'll wrap there. Holly, thank you so much for taking your time to submit your portfolio, come on the show and share your journey with the Equity Mates community and with Luke.
Thank you guys so much for having me. When I heard that I was getting Luke, I thought I was going to be in for a fat roast, but no, this has been fine.
Look, behind the scenes, Luke is actually really nice.
I love the fact that everyone's scared. It's kind of exactly where I want them all. It's exactly where I want them all.
Maybe we should have a new segment, Fat Roast. No worries, Holly. Well, if you would like to submit to Pimp My Portfolio and not get a fat roast, but get everything that you've heard today, plus over the other segments over the last few weeks, head to equitymates.com/advice. You'll find all the information there. Additionally, we can connect you with Luke if you would like to have a proper conversation about your personal circumstances and your investment portfolio. We also have a number of other advisors that we can connect you with depending on your situation. So equitymates.com/advice for all the information.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.